Morning.
Hey, good morning.
How are you today?
I'm doing good. How are you?
I'm good. Let me take it down out my mouth. Okay.
Perfect, perfect. All right.
So
You
we're not
look
going to
all
be doing,
sun-kissed.
yeah, I'm in the car on the way home, just leaving the doctor's office.
Okay, okay. Good stuff.
So my
I,
husband is driving, even though he had eye surgery. I can't see anything.
oh, hey, Mr. Crossley.
I got the earphones in. He can't hear you. She said hi.
All right, all right. Well, I'm just gonna go live on Instagram
Okay.
and
I'll just do my
yeah.
recording. I'm not going live today. So,
All right, good. I'll just do Instagram today. Hello, hello. Welcome to Ask the Experts with myself and Miss Vanda Crossley, lender with Loan Factory and EXP Real Estate Agents. I am also a EXP Real Estate Agent, and we are here to answer your questions. And so we have some good questions for today. And of course, I put them in the other phone that I need to be live on, but that's okay. All right. So our questions for today. First question, and keep in mind if you're tuning in and joining us, you're more than welcome to ask questions in the chat. We would be happy to answer those. But our first question is if we had someone ask, what is the minimum down payment or what is the minimum that I need to have saved in order to purchase a home?
well, that depends on the loan product. So there are some loans where you don't need any down payment, like USDA, VA. So if you're doing a FHA, for example, you need 3.5% of the purchase price. And in addition to the down payment, you're going to need money for option fee, which is a unrestricted right to cancel at any time. Usually that's two, three, four, $500. And then you're going to need money for inspection because you want to get the place inspected. Most inspections cost about $500 on the average. And of course, you want to have a little cushion. You don't want to be broke as soon as you move in. So you want to have some money in the bank, a couple of $1,000s. So, and then there's closing costs associated with each transaction. So you still have to come out of pocket for paying for like insurance. They call them impounds or escrow, taxes. They may want that up front. Each lender is different. So on average, we say between 5 to 7% of the purchase price is what you need to have in a savings account somewhere. Checking, savings, 401k. You can also get a gift from a family member. So if you don't have it all, you just need a gift letter from your mom or your brother or somebody that can give you a couple $1,000s. So there's various ways to get it. And the funds do have to be sourced. So they can't be money that you have in your mattress, under your mattress, or in a book that you've been saving. You put it in a brown paper bag, and I've been saving this money. Put it in the bank so it can be seasoned, as we call it, and it's already in your account. We don't have to ask where this money comes from because, as money laundering is a thing, and so we need to know where that money comes from. And another good source of getting some down payment money is GoFundMe. There's a GoFundMe account for almost everything. GoFundMe for this house. Christmas is coming, birthday presents. Have your family members all help contribute. They're gonna want to come over and have holidays at your house. Help everybody put in. So GoFundMe is a source of down payment money. So there's a way. So if you need some um, ideas on things like that, contact me because I can give you some really great ways. And there are also companies that will match. If you saved up 2,000, they'll put in 2,000. They'll match your savings amount.
Wonderful, wonderful. So great information. Just to recap a bit of that, the question was, what is the minimum amount that I need to have saved in order to, start moving with home ownership process? And Vanda was recommending 5 to 7%. And that's a good, healthy. So you're looking at on a $250,000 home, you're looking at 5% of that would be 12,500. Okay. We know that the market is trending upward, where most homes that are now considered affordable housing is right at 426,000 and below. And so, there are still great homes out there in the $250,000 range, but that just gives you an idea of what you can expect to um, have to save up or have. Um, Towards down payment, again, those closing costs and things like that. Now, looking at it, 350,000 times the 5%, that's going to put you at 17,500. And also, what Vanda was saying is that there are ways for you to get these funds, not just by saving them. There are ways for you to get them gifted to you through GoFundMe, through there's gifting websites where you can save and people can contribute for weddings, birthdays, whatever, towards your house. You just have to make sure that any mattress money that you have gets seasoned in the bank. Okay.
And
And so
there are
definitely reach
sellers.
out.
I'm sorry, there are sellers, I forgot to mention that, who a lot of them contribute to closing costs also. So if you don't say, well, I don't have 12,000, there's no way I can get 12,000. Sometimes the sellers can also help you with that out of their funds.
Yes, absolutely, absolutely. So if the sellers are doing that, and a lot of sellers are offering concessions right now,
Mhm.
because homes are moving a little slow. Our average days on market have gone up. And so sellers in their need to kind of close out before the end of the year and trying to sell. Some sellers have been on the market since summertime, since early spring, and they're just sitting, and so they're willing to offer you those concessions. They're willing to offer considerable cost towards repairs and things like that. So it's just really important to make sure that you know your number, right? And then we can go in and know what we need to ask for. So if you're in that range where you need the 12,500 or you need 17,500 and you only got 5,000, then we know that we need to be asking or researching, looking for 12,500. And a great point that Vanta mentioned is that you don't want to get into the house and be house poor. You want to make sure that that you have some cushion so that you can actually like move in and have a setup. You can buy furniture. You can just be prepared for any additional costs that you may want to do, landscaping or things like that, that you've got a cushion for those things, and that you're continuing to save throughout to be able to provide the maintenance for the home. So very good. But again, if you want to run your specific numbers, you can always reach out. And again, Vanda is with the Loan Factory. She would be more than happy to assist you in navigating those numbers. Our next question is, what is DTI and what is considered a good DTI? So DTI is an abbreviation. We use a lot of abbreviations in real estate. And so good questions to ask. Never assume, always ask for clarification. If we're rattling off terms, because it's habit, right? If we're rattling off terms that you don't understand as a buyer, as a seller, please make sure you ask so that you have a full understanding of what's happening in your transaction. So DTI is debt to income ratio. Okay. It is a ratio that lenders use to determine, partially to determine what your lending profile is going to look like and how much money they can loan you. Okay. And so the debt to income ratio is how much like debt you have versus the income you're bringing in. Okay. And so, Vanda, talk more about like what is considered a good DTI.
A good DTI is around 35%. Some lenders will go up to 43%, and there are some that will go up to 50%. But if we run your numbers and your DTI is over 50%, it's kind of like an automatic denial. It's like, nope, they got too much debt. We don't even want to go any further with this. So then we start getting into why and getting into maybe credit repair and what debts can you pay down? What debts can you pay off to get this down? Because sometimes it's just a matter of omitting the car payment because it's going to be paid off in 2 months. And then that can be paid off at closing. Or it could be pay this credit card down to $1,000 instead of having $2,000 on it. So we need to look at that and see how we can adjust your DTI. Because we look at like 1/3 of your income that's coming in should go for your home. And then the other part, the other third, you have your car, your bills, and then you got utilities. You still have to live. So we would not, a lender would not get you into a home where half of your income is going towards your housing. So we look at like 35% is a good DTI. So there's a number, we plug it in and it'll tell us the front end and the back end DTI.
Absolutely. Very good. Very good. And that's a good point that you brought up. A third of your income. Like a good lender is not going to set you up to fail, which leads to our next question, but I'm going to get to that in a minute. But a third of your income being allocated towards housing so that you can make sure that it's affordable in the long run, right? Again, you always want to provide yourself with a cushion. If the budget is tight to begin with, then you don't leave yourself enough room for maintenance issues, for car issues, right? Because we're just talking about the house, but there are other things that your income is going towards that need to be considered. Insurance rates going up, right? All of
Mm-hmm.
those things, inflation that we're experiencing. You still got to get to and from work, right? So gas went up, but paycheck's still the same, right? Making sure that you are set up for success and that you have the room that you need to function and live and not just be what we used to call house poor, right? Where you got the
Right.
house, great, but you can't do anything else, right?
Can't do anything
And
else.
so,
Can't go out to eat. You can't go on vacation. You can't do any of that stuff because you got a mortgage you got to pay for. We don't want that. We still want to be able to live. And one of the things that I'm going to start asking people is what is the monthly payment you can afford versus, how much house can you afford? Because sometimes you look at, you say, oh, 300,000. Oh, that's a lot. I can't afford that. But if you look at the payments and you're paying rent and looking at your utilities, you can afford a $300,000 house because you're already paying for it monthly. You're just paying it to the landlord, and it's not coming into your pocket and helping your bottom line.
right. Likewise, on the flip side, I have people coming in with lower budgets, right? They're saying, hey, I can only do this much. And, even to those people that say I can only do this much a month, right? You have to look at what all comes with home ownership, right? It may not be the right time for you because if you can only do so much, right? And like we just talked about, the housing market is going up, the cost and affordability may not be there, right? Don't force something, right? If now is not the time, it's just not the time, and that's okay. But we don't want you to get into this situation, which leads to the next question, which is how do I avoid foreclosure? Okay. Well, it starts with when you buy. Okay. Nobody has a crystal ball. We cannot predict, what life is going to be like in 5 years for you, 10 years for you. And so it's buying for what you can afford right now, right? Of course, we hope we get raises and bonuses and things along the way. Maybe we start a business and it takes off and it's wildly successful, and all of that would be great. But if that doesn't happen, could you still afford your home? Avoiding foreclosure starts with the buying process and not buying something that is going to over leverage you. Okay. When you consider what you are paying monthly, it's going to be your monthly payment, your so principal, interest, you pay your taxes, and your homeowner's insurance. Okay. Those are the four core things. The taxes and insurance can be escrow, which means it's added to your monthly mortgage payment, or it can be paid at the end of the year in a separate payment. Okay. It depends on what works for you, right? If you know, like you struggle with saving money and you know you're going to get to the end of the year and you're not going to have those funds, like just have it added into your monthly payment, have it split up that way. That way, you know it's covered. Keep in mind that property taxes do go up each year. And so it's possible, unless you protest, make sure you protest your property taxes. Get with us. We can help you print some comparables so that you have real numbers. But yeah, you want to make sure that you account for those things. Homeowners insurance just went up like crazy. I'm in the process of shopping homeowners insurance right now for next year. And it is just the reality of the climate that we live in, right? And so you want to be prepared for those increases. Go ahead, Vanda.
So one of the things that I heard today when I was on Clubhouse, I don't know if you were on there or not, but Guy Bryant said that Houston was being reevaluated to be a flood zone, like almost all the properties in Houston is going to be designated in a flood zone. So your insurance is going to go up. That's just crazy.
Yeah, because even with our flood districts work to kind of shore us up, we've had exponential growth in Houston and surrounding areas in the past few years. And they did not accommodate for floodways and how that was going to be navigated, hence Harvey, and the effects of Harvey, right? People who had never flooded before found themselves in waist deep water um, that never thought that they were in a floodplain, right? And so the flood control district is working to repair that. But yes, they are redoing the flood map, and it is going to include more properties. And so we have to consider that because if you are in a flood zone, the insurance companies more than likely will require you to have flood insurance. The other thing is, or lenders, right, when you're purchasing, will require
Mm-hmm.
you to have flood insurance.
Mm-hmm.
Okay. That may very likely become a requirement. The other thing to consider with insurance is that a lot of insurance companies are getting out of Texas. Recent weather that we've been experiencing that has been unlikely, the severe tornadoes and windstorms. They're raising the percentage of your wind and hail. It's a section on your policy if you've never read it before. Typically, most people who are seeing increases right now, that's the section that has increased, where it was a 1% deductible and you could get away with that. Now they're pushing it to 3%. So be mindful of that. That's something to look at and to consider as you are purchasing a home. Is where you're purchasing it. Is it in a flood zone? Is it in a floodway? Right. Also, is it considered, what your homeowner's insurance is looking like? As soon as you get under contract, start shopping for that homeowner's insurance, making sure that you are aware. If you already have a company for renters insurance, homeowners insurance, your car insurance, get a quote from them in areas that you're considering and kind of talk through what that's going to look like, so that you can be aware of those monthly costs. upfront.
And your insurance premiums have to do with your credit score and your history with that as well. So try to increase your credit score so that your insurance is not through the roof.
Absolutely, absolutely. Very good point. And so, yeah, to avoid foreclosure, it's definitely in the buying. However, should you already be a homeowner and you need some options, first of all, I will speak to my veterans, right? Veterans Day was just on Monday. Let's take a moment to thank you for your service to all veterans. We appreciate you so, so much. And so
Thank
for
you. Thank
veterans,
you.
there are programs that will provide assistance for you. If you're already a homeowner and facing some difficulties, reach out to the Veterans Affairs Department as well as your lender. Communicate, even if you are not a veteran, communicate. Don't just sit in your house like, I don't know what to do. I'm gonna just have to let it go. No, there are programs out there designed. NACA has a program that even if you are not or did not initially go through the NACA process, you can still contact them because they are essentially home buying counselors. Okay, that
Mhm.
is their job and their role. And so they want to help set you up for success. So if you are already in a homeowner and you're experiencing financial hardship, and you need some assistance, reach out. Okay. There are a number of other nonprofit organizations that provide assistance in various ways, but don't let it get so bad that someone can't step in and help you. Okay. Likewise, the other alternative to those programs is reaching out to investors. If you don't know them, we know some. We can always get your property in front of an investor that's willing to purchase it, maybe do a lease back situation with you, or just buy it outright and we can get you into something else that is more affordable. Again, we want to do all this before it gets really bad, before your credit is affected, before it's too far gone, right? It's not a matter of being able to let it go so bad, right? And then we can't help you. I mean, there's options at every stage, but the options get more impactful to your life and you moving forward the further you get in. Okay. And so, if we want to come out optimally with minimally affecting your credit or not affecting it at all, then you got to reach out quickly. Okay. Don't get in the process of drowning, and we got a life raft for you. Okay, so
Yes,
just
they call it
it,
putting your head in the sand and then
yeah,
I don't want to
like,
deal with it. I don't want to deal with it.
no, no, no. Reach out, reach out. We understand that life happens, that situations come up, you get laid off, like things, medical bills pile up. Okay. We completely understand that those things happen. So never feel embarrassed or never feel in shame to reach out and get the assistance that you need before things get bad, um, so that we can make sure that you are able to move forward in the best way. So yeah, preventing foreclosure starts with buying. It's also going to start with making sure that you are reaching out when you need assistance, so that you can get the help that you need. Vanda, did you have anything else in regards to avoiding foreclosure from the lender perspective?
Don't be afraid to you have a 3 bedroom house and it's just one of you there, rent a room out. And it could be temporarily until you get back on your feet. You have an asset. You can use it. You might need to rent the whole house out for a period of time and go live with somebody until you can get back on your feet. But, just reach out because there are options for every problem. There are 10 solutions. You just have to find the one that's going to work. The first two, three may not work. Let's keep going down the line until we get to 10. I guarantee you by the time we get to 10, we're going to have a solution for it. So, and don't
Absolutely.
be afraid I believe in community living. You don't have to live in a house by yourself. You can have other people, other family members, or strangers, or not strangers, but um, friends. to come live with you and share the expense. Why do you have to carry the burden all by yourself? Even when purchasing, you can have up to four borrowers on one loan. So at least one of those people
Yeah.
need to live
Four
there.
borrowers. Four
Hmm.
borrowers can be on one loan. Okay. So take that into consideration. Sharing is caring. In this climate, you may need to share a home. You may need to share a residence. And the way that they build them now with these split floor plans, you don't have to be right on top of each other. But if you're pooling money together and pooling resources with people, I know sometimes it's like finding like-minded people, but people that you know, like, and trust, and getting into home ownership. Maybe one person is renting out to other people, renting out a room, like Vanda was saying, but looking at all avenues to be able to facilitate uh, funding, helping you fund and pay that mortgage, or y'all paying a mortgage together in order to be able to live in the place that you want to live.
With the people that you want to be around.
Yeah, for
You know, just
sure,
think
for
of the
sure.
Golden Girls. You remember the Golden Girls? You may be too young for that show.
No, Golden Girls. It
Where
was
they
a pooling of resources. Yep.
Yeah, they all lived with Blanche. It was her house, but they all had their own room and they shared and they, met up in the kitchen and cooked together and, they shared a life together because they couldn't afford to live by themselves. What's wrong with that? I love that idea. I live in a multi-generational house, so that's what we do.
Find the community where you can. That's Golden Girls is a great example of finding the community where it is. It ended up working out for them, and it can work for you too, right? We do take precautions, right, and evaluating others and things like that. But for sure, it's a great way to live and find community and not feel like you're isolated or by yourself. So. Awesome, awesome. Vanda, do you have anything else before we close out?
I don't. Just reach out. I can be reached at 773-678-1085. That's my cell number. Or you can find me at theloanfactory.com.
Beautiful, beautiful. And I am Janila. You can reach me at 281-215-3307, or here on Instagram. Feel free to reach out if you are looking to buy, sell, rent, um, or have any investment questions. I would love to assist you. Or you are a veteran looking to purchase or sell. I would definitely love to assist you. I have a heart. My husband is a veteran, so I definitely have a heart for veterans. But we are absolutely here to serve you, answer your questions, and get you to the path of home ownership, or onto the next home that you need. Thank you so much for tuning in to Ask the Experts. We will see you the second Tuesday in December, our last Ask the Experts of 2024. We made it 12 months.
Yay,
It's
yay.
going to be a fun and a wonderful time celebrating our 1 year. So we hope to see you there. Bye.
All right, bye-bye.